The following podcast was recorded on Tuesday, April 26th, 2022, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim's going to give an update on the bond market carnage. When measured on a total return basis, the bond market, Jim, is in historic decline. Start us off by detailing the losses.
Yeah, so first of all, a quick word about total return. That is the measure of the yield you receive plus the price change. And what happens with bonds typically is as the yield goes down, the prices become more sensitive to changes in interest rates. And that's referred to as modified duration. And modified duration is not always constant over time. It changes depending on the level of interest rates, and that's referred to as convexity. And the reason I'm such a big fan of total return is it is probably the best way to answer the question, well, interest rates from 1 to 2%, that's a double. Does that mean then that when they went from 13 to 15% in the early 80s, that this was way bigger than that move? How do you, or when they went from 7 to 12%, 20 years ago, how do you compare those periods? I think the smoothing factor through all of this is total return. So if you look at the first chart we have, this is the global aggregate index. For those of you old timers in the bond market, this was Lehman Brothers, then it became Barclays, and then Bloomberg bought it in 2016, the index business. So it's Lehman, Barclays, now Bloomberg index. This index here, global aggregate, is about $65 trillion of bonds, about 28,000 bonds. And you could see the green line shows you the best year ever, 1995. It was up 19.66%. By the way, this index started in 1990. The worst year ever was 1999, down 5%. And you could see the black line. Nothing close to this has happened to the bond market since 1990. When this measure was created, we're down 10.4%. Now, if you go to the next chart, this is the U.S. aggregate index. This chart starts in the mid-70s. The stair-steppy nature of the chart is when they used to calculate it monthly. Best year ever was 1982 when it was up 32%. The worst year ever was 1994 when it was down 2.92%. It is down 949. And you can see that 1980, when again it was calculated monthly, it only got down to minus 8.7. We don't know what the ultimate daily loss would have been because it wasn't done that way. But nevertheless, we're worse now than we've ever been. Now, if we go to the final chart, this is the 2-year note yield. This chart goes back to 1976. So 1982, 21% return. Yeah, you could have gotten a 21% return holding the 2-year note in 1982. And the worst year ever, and the only full year for a loss in the 2-year note was last year, when it lost 0.58%. And now it's down 3.29%. Now, quick word about the 2-year for people that are not steeped in the bond market. 3%, have you seen what's happened with, Kathy Wood's ARC fund and stuff? Well, the buyers of this thing are not the same thing as a buyer of an unprofitable tech company or some other volatile cryptocurrency. Typically, the buyers in this market are people that use a tremendous amount of leverage because you have a repo market, a repurchase market. So if I'm a hedge fund, I call up Goldman Sachs, just to pick a name out of the sky, sell me $1 billion worth of 2-year notes. Okay, done. Do you have $1 billion? No, but I can give you the $1 billion of bonds and you can repo them out. And my interest cost on that would be about 80 basis points, and they're yielding about 2.7%. Wow, so that's a positive carry, except when the price goes down 3%, I could wind up with huge losses. Anybody remembers 1998? Long-term capital lost about 40 or 50% at its worst point in 1998. Its assets, like this chart, were only down about 2%, but they were using 40-to-1 leverage. So keep in mind that the buyers in these stuff is extremely levered. So if you add up all three of these charts, you have got a historic sell-off in the bond market right now.
How about positions and opinions that are looking for a low?
Yeah, so obviously, if you've seen what we've talked about so far, your reflex is, oh, when is it going to bottom? It must be a buy. As a matter of fact, everybody's been trained, to buy the dip in everything. If you're a good stock investor, I could show you a chart without a title on it. Look, it went straight down, buy it. And that's what everybody's been saying. Now, the thing about the bond market is it's worth noting that since about Thanksgiving, everybody that it comes into focus, hey, look at the sell-off in the bond market, it's a buy. And they've been getting crushed and carried out left and right. And they will continue to say this until it eventually does turn. And then whoever said it last will be Nostradamus at that point. But if we look at positioning, there really isn't a whole lot of panic in the bond market. So the first chart we're going to look at it's a fancy word. This is the commitment of traders report. This is the futures market breakdown. And we look at all of the treasuries. This is the 2-year futures, the 5-year futures, 10-year and 30-year futures contracts. We do it, well, they're all different contracts. They're all different sizes, different durations. How do we normalize all of them so we can add them together? We use a Z-score. All that is how many standard deviations from a 5-year average are they? So if you add it all up, you come to something that's very close to being zero. 0 standard deviations away from the 5-year average. In other words, the positioning is very much at a neutral kind of place right now. And in the top panel shows you the 5-year yield, even though it's been shooting straight up. Now, if you go to the next chart is the 2-year note net positioning. So this is just the raw positionings. All the people that are long it minus short it. We're looking at large speculators in the second panel. They're net short 118,000 contracts, but notice they're almost always net short this market, but nothing extreme. We look at the middle panel, that's the hedgers and the commercials. They're almost always net long the market. That's not unusual for futures contracts to have the speculators always long or always short, and the hedgers vice versa. But it's a fairly neutral position. Small traders are extremely short, but the small traders is the hardest category to read. The large speculators in this contract are people that own more than 1,000 contracts. That's $1 billion a par, and don't trade the cash market. Hedgers are you own more than 1,000 contracts, and you do trade the cash market, and then you take all their longs minus their shorts. But what you see in this chart here is a fairly neutral position. The small traders are a little bit extreme. Go to the next chart. Let's ask, what about economist opinions? The black line on this chart is the 10-year yield. All those colored lines are the quarterly forecasts, quarter-end forecasts by economists as surveyed by Bloomberg. They update this survey regularly, a couple of times a month, 3 times a month or so. You'll notice that from 2020 till about 6 months ago, all the colored lines were always above the black line. Everybody's been bearish the bond market for 20 years. So that's not surprising that we see that. But what's happened in recent weeks, months, last couple of months, is the yield rise has outstripped their forecast, or they're unwilling to really up their forecast. The most aggressive forecast we have right now is for the second quarter of 2024 at a 310 yield. It's about 30, 40 basis points higher than we are right now. And, there's no real structural bearishness like we had in 20 or 21 when all the forecasts were above the current level. The final chart we'll look at here is Consensus Inc. Consensus Inc. is they look at a whole series of futures-based newsletter writers and brokerage house research in the futures market. And they basically put them in a pile, which ones are bullish and which ones are bearish. So it's a little subjective, but they've been doing this for 30 years, so they kind of got the story down as well. And they publish a number for each one of the futures markets, what percentage of people are bullish. Well, for the bond futures market, it's 22%. And you can see that that's about the lowest number we've seen in 20 years. So is there a group that is uber bearish on the market? Yeah, the small traders are in the futures contracts, and the brokerage house newsletter writers are too. Quick word about brokerage house newsletter writers. They tend to be technical analysts. They tend to be momentum driven. There's nothing wrong with that. I am a CMT myself, a chartered market technician, but technical analysts tend to be momentum driven. So with the momentum being straight down in bond prices, it's not surprising that they're uber bearish. Now, not everybody's neutral. There are some instances of people that are very bearish, but if you ask, what do broad economists think? What is the positioning? And something else I haven't shown, the surveys of bond managers, they're all looking for a low. They have been for a while. They're not overly worried that the next big move in rates is going to be higher. They think it's going to be lower. In other words, we don't have a capitulation yet. Just it, get rid of everything. The bond market's terminal. It could never do anything but go up in yield. We don't have that yet. We don't have positioning extraordinarily short. So if you think that there's a capitulation low in the bond market, this data is not suggesting it.
So when do yields peak?
The line I've been using and many people have been using is yields peak when something breaks. Now, a couple of things about that. First of all, the bond market moves up and down every day for 100 years. Not every move is a historic move. So when you have the jiggles in the bond market, most of the time, they can peak on whatever reason they want, sentiment or sentiment psychology, momentum, fundamentals, then they turn and they go the other way. When you get the bond market to have these kind of historic moves, 1980, 1994, 2006, 2018, and today, those kinds of historic moves tend to go until they break something. And this is the biggest of all of them. Now, what does break something mean? It usually means that interest rates go high enough that they affect something other than the bond market. In other words, the stock market peaks and sells off hard because of high interest rates. That's what happened in 1987. The bond market, the stock market was going up, up, up. Bond yields were going up. Everybody was telling you why it didn't matter. It didn't matter. In the fall of 1987, 10-year yields hit 10%. It was a different era back then. And then the stock market cared all at one time and culminated in the stock market crash of October of 87. So yields kept going up till it broke the stock market. 1994, 2019, yields went up, and I'll use the 94 example. And then eventually what happened was the brokerage firm Kidder Peabody went out of business. They had to file for bankruptcy because of the losses in their bond portfolio. The Orange County, Orange County, California's treasurer was speculating in the bond market on leverage. He wound up having the whole county go bankrupt as well too. And by the spring of 95, we had to see Mexico devalue the peso in what was referred to as the tequila crisis. And in 2019, the repo market blew up. So another way things can break is the plumbing of the financial system breaks. Brokerage firms go out of business, levered traders file for bankruptcy, long-term capital 98 is another example of that, or the repo market blows up. Final example of that could be the economy or the real economy has problems. The Fed raised rates in 2004 to 2006, 17 consecutive times. By 2006, the funds rate went from 1% to 5.5%. About 40% of all mortgages outstanding were adjustable rate mortgages back then. Greenspan famously told everybody to take out an adjustable rate mortgage around 2002, 2003. And those adjustable rate mortgages got adjusted higher and higher and higher. And by the fall of 2006, housing prices peaked, and that was the lead in to the financial crisis of 2008 when subprime had problems as well too. So you can get an example where rates go up, you get what we refer to as demand destruction or altered behavior in the real economy. and that leads to the economy being hit. These are examples in the past of every big move that winds up breaking something. What could break this time? You don't know. I can't say, watch for the stock market to do X, or the repo market to do Y, or housing or anything else, or auto loans or whatever to do Z, and that's the definition of break. We don't know, but what would be wholly out of character? Let me turn the question around. Historic sell-off in bonds. Oh, they're oversold. Buy bonds, they're going to go back 100 basis points the other way. Stocks go to new high, inflation goes away. That would be wholly out of character. To have a huge sell-off in the bond market and then it just reverses and nothing came of it, that would be the unusual thing. When we get huge sell-offs in the bond market, big rises in rates, it changes things. It doesn't stop until it changes things. So watch the plumbing of the financial market. Watch the stock market, which has been getting a little bit wobbly on the news here recently with higher rates. Watch the economy, whether or not we're going to start to see demand destruction in housing with 5% mortgages or other places as well, or a combination thereof. But what I will tell you is, when the final chapter is written about this, I do believe it'll be 2022, rates went up, then this happened, and rates went down. And this happened, I don't know if that's happened already or it's going to come, but it's not apparent right now. But if you told me it's going to be, oh yeah, rates went up a lot, and then some Tuesday they turned around and they started going down for 2 months, that would be unusual. So I'm still thinking that rates are going to continue to trend higher until they break something. Now, maybe they back off for a month or two right now, and that break something is not until summer or early fall, or maybe they keep going now and that break something is in the next couple of weeks to a month or two. Remains to be seen, but the ultimate move, it will change somewhere, behavior somewhere. That's what I mean by if the stock, if it is, we just want to have a giant rise in rates and then they're going to turn around and they're going to go down and stocks are going to go back to all-time highs and everybody's going to forget about it. And it'll be a trivia question at the end of the year. Oh yeah, you remember when rates went up a lot and then they turned around and went back down? That's usually not the way these big giant moves work. They go till they change something. They go to a firm goes bankrupt. The stock market sells off hard. The economy goes into recession, or the leading indicators of the economy goes into recession. Yeah, this is not a bullish story. It's not a happy story. But this is what happens when you have a giant rise in rates.
Well, Jim, thanks for your thoughts today. Thank you everyone for joining us. As a reminder, we are client driven. If you have any questions or feedback on future topics, please let us know. For any questions or further information on Bianco Research, Arbor Data Science, or Arbor Research, please contact Gus Handler at gus.handler@arborresearch.com. Have a great day.